Well, this is one of my favorite sessions every time, and it's one of the most popular sessions. This morning, our economic experts will share their perspectives on drivers impacting pork prices and profitability, both internationally and domestically, and it's my pleasure to introduce our speakers to you. The first person you'll hear from today is Dr. Lee Schulz. Dr. Schulz joined Ever.Ag as the chief economist of their livestock division in 2024. In his role, he speaks on various industry topics, develops and delivers economic data and analysis, and works with clients to provide critical perspectives. In 2012, he joined the economics faculty at Iowa State University, where he served as a professor and as the statewide extension specialist on livestock, economics, and markets. Lee received his bachelor's degree in agriculture business from the University of Wisconsin River Falls, a master's of science in agricultural economics from Michigan State University, and a PhD in economics from Kansas State University. And just so you know, Lee does a lot of presentations to the National Pork Board of Directors, and so he was presenting to our board on Monday and Tuesday, and I always have a running joke with Lee as an animal scientist. I said, Lee, I'll give the talk this time to our board, and I'll be the economist because the markets look really good, so I'll just take this. Now, Lee, I'm still kind of frustrated you did not let me do your presentation to our board of directors on Tuesday, so he said the animal scientist needs to stay in his lane. The second speaker you'll have today is Mr. Joe Kerns. Joe has over 40 years, 40 years of experience in agriculture markets, spanning the matrix from grain and feed and inputs to our revenue items. He has traded them all. And Joe, how do you work in the business for 40 years when you just celebrated your 21st birthday? I'm not figuring out. The math ain't mathin'. So welcome to the economics talk. He recently transitioned from his role as president of the livestock division at Ever.Ag to his new endeavor at AgRubicon. This is aimed at, and the mission is, giving back to the production community. Joe maintains a relationship with Ever.Ag and is proud to represent them on the stage at the World Pork Expo. So we will entertain your questions after these two gentlemen share their knowledge and impart their wisdom with you today. So if you do have questions as we go through the discussions, please make a mental or physical note of those, and then we will get through those, like I said, towards the end of the session. So with that, Dr. Lee Schulz, we welcome you aboard here. Let's give him a big round of applause as he comes forward.
Morning, everyone. There we go. All right. Mic check. All right, so important disclaimer for me here. Importantly, everything you're going to see is publicly available data. Each and every day, I have a greater and greater appreciation for USDA, National Ag Statistics Service, AMS, Ag Market Service, ERS for the data that they provide us. This presentation would not be possible without the services, the data that's not only provided by producers, by packers, but then also USDA in their role in providing this data to us. So I think greater and greater appreciation for them. Along those lines, I've been starting a lot of these talks looking at the reports that are going to help us confirm some of the fundamentals in our marketplace, or maybe help steer us a little bit differently in the way we're thinking about things. So as we look at the next month or so of the reports that are going to come out from USDA, we'll get a better idea of the hog and pigs numbers near the end of the month. That survey is going on right now as producers are submitting data, providing head counts to USDA, and those calculations will be going on later in the month to give us a better idea of those hog numbers. We continue to watch the World Ag Supply and Demand estimates for not only current production numbers and demand numbers, but also looking at their forecasts. And in a time like this where we have very dynamic markets with changing policy, and very important to look at their forecasts given the prevailing fundamentals and policies in place to look at where our markets may be going. I also like to look at ERS's livestock, dairy, and poultry outlook. That provides even further forecasts and context to some of those forecasts as we think about the data that's being released. Now, as I reflect on some of the latest reports from USDA and we look at their latest PDI report, I think really highlighted me the situation that producers have been facing over the last several years. And maybe not, you can't look at one individual number to maybe depict that whole situation. So as I look back at 2024, that was one of the better years by some metrics that pork producers have faced. But also you'll see on this graph, 21 and 22 and even 23 shows up as some of the better metrics if we look at it from a production standpoint, a value production, or cash receipts. Now this doesn't tell the whole story, so maybe some of the sheen here I'm going to back off as we talk about the situation that producers and the production community has been facing over the last several years. One other update that we get annually, and this is in the Livestock Annual Slaughter Summary Report, is a count of the number of federally inspected pork packing plants and the throughput through those plants. You could argue that we've seen some unprecedented change from the packing side of things, where we've added over 100 plants in the last 2 years. And so you'll see that's the blue line here, up to 763 federally inspected plants. The throughput last year was a little over 129 million hogs through the system last year. But when you dig into the data, again, all provided by USDA, you'll see all 100 of those plants came in that smallest category of 1 to 999 head per year. If you work through that math, it's about 1 head per day. So when you think about the capacity changes in the industry, certainly from a number of plant standpoint, we've seen great additions. But when you look at the overall capacity of the industry, think about that from the blue line or the pink line here, that hasn't changed overall, right? And actually you could argue we've kind of squeezed some of that capacity out of the system. Now it's important to look at these numbers because this will impact, certainly when we think about slaughter supplies as we get into the fourth quarter, the available capacity that we have. This is always a moving number because there's physical capacity, so there's a number of plants and the shackle space that we have. But over the last several years, we've talked about challenges to operational capacity as it relates to labor. So that continues to be something we monitor as it relates to the available capacity that we have in the industry. We'll talk a little bit more about this later, but I think the industry is in a much healthier spot today than maybe it's been the last couple of years because we've squeezed out some of that excess capacity. So I'm going to give you the end before the beginning here and kind of summarize the talking points. So I encourage you to look for these particular points as I cover the few slides that I have. First and foremost, consumer demand. You'll see that, yes, we have taken a step back from the last several years that have been really some of the strongest consumer demand, but we still are in a good position versus historical levels. I'd argue the same factors are going to determine demand, but it may be a little bit of a reordering of the leading and lagging factors that are determining that demand. Exports, a lot of discussion about exports, not only current throughput of exports and volumes and values, but also forecasts to those exports. USDA is still relatively optimistic, down about 8%, 0.8% from a record 2024 level. Now, the question I always have when I talk about quantity is at what price, right? So that'll give us the total demand, not only from a domestic standpoint, but from exports as well. We'll talk a little bit about costs. I think there's a new normal to the levels of costs. I don't necessarily like that phrase, but I think we've settled really in at the mid-80s when we look at hog production costs, kind of on an average industry benchmark of looking at those. Productivity gains continue to be the driver of increases in production. We're at a very steady inventory level, yet continue to produce larger quantities of pork, available not only domestically, but also for our export customers through increases in carcass weights, through increases in litter rates. Right now, forecasts are for a moderate 4% increase in hog prices, coming off of what we've seen about a 3% increase in 2024. Now, a lot's talked about demand as it relates to the economy, consumer incomes, consumer sentiment. This is one of the more popular kind of metrics that I know we've been following as it relates to consumer demand. Consumer incomes matter to demand, right? And when you look at when we survey consumers and ask them, this is a survey out of the University of Michigan, about not only their sentiment but their expectations, we're at some of the lowest levels we've seen in a long time. We had 4 consecutive months that were plunging declines. May, you could argue, was kind of a stabilization period for some of the consumer sentiment. And it's really kind of the prevailing factor is stagnating consumer incomes. So we may get some positive news as it relates to policies related to tariffs that may provide a little bit more positive sentiment from a business standpoint, yet consumer incomes remain stagnated. We still have the impact of inflation on consumers. Now, when I look at demand, you need 3 variables here. You need the quantity consumed, the price paid, and then you need to adjust for inflation. In the first quarter of 2025, overall at retail, we ate 3% less pork. Consumers did pay higher prices, but they paid higher prices at the pace of inflation. So overall, real prices didn't increase. And so this led to a decline in demand relative to the year prior. Now, you'll still see on these red bars the index levels. They still remain at a good area or a good level, at least compared to historical. But yes, we've declined from some of the heights that we've seen in 2020 through 2023. Now, I started with talking about incomes. What was different about the earlier part of this decade? We had a lot of consumer incomes. We had stimulus in the economy that certainly led to increases in pork demand. Now, you may ask, where do you think demand is going over the next couple of quarters? I told you looking back historically. Well, let's look at those 3 factors now impacting demand. So per capita consumption, latest forecasts out of USDA are for increases in per capita consumption the next 3 quarters, which would slightly offset the decline that we've seen in the first quarter. And so you'll say, well, consumers are eating more. That's one positive signal to consumer demand, right? But I already reminded you we have to know at what price that consumers are going to be purchasing that pork. Now, luckily, USDA, out of their food price outlook, has some forecasts on those prices. Now, like any good economist, they have a pretty wide forecast range, right? So their forecast range is roughly about a 4% increase in price to a 4% decrease in price. The midpoint is slightly below last year's levels. Now, at the midpoint, if that all proves true and the per capita consumption proves true, that would be a decline in demand because we have to adjust for inflation, which is slightly over 2%, right? Now, where I would be confident to say we would have an increase in demand is if we do see the 4% higher prices. Even after adjusting for inflation, consumers would eat more pork and pay slightly higher prices for that. The only reason you can get that is an increase in demand. Now, you might ask, why are we going to eat more pork in the U.S.? Well, part of the reason is if we do see a reduction in export levels, we will consume all that we produce. And so if it doesn't go to the highest valued market at an export, or there is not alternative foreign markets, we will potentially consume that domestically. And the question is, what is the market clearing price there? 4% higher would certainly be an increase in pork demand. Now, as we look at prices not only for pork that have increased here 2% year over year, they actually decreased from March to April. We can look at substitute prices as well. So price of beef, price of chicken. And when you look at the spreads between those prices, we are at the highest spread between beef and pork and beef and chicken than we've ever been at. So there's a lot of debate about how much do beef prices, chicken prices matter to the demand for pork in this case. Now, there's been research that's done that. My only pushback on some of the argument that maybe those prices don't matter as much, consumers are less sensitive, is that we've never been at these levels before. So we're kind of outside the bounds of the data, meaning that we need updated research to understand what are those relationships at these elevated prices between the spreads of substitute prices. As I walk through the demand situation, we'll talk about the cutout next. We've seen the cutout higher 15 of the 22 weeks so far here in 2025. The last 2 weeks it's been higher. Really, it's been a tale of three stories as we look at 2025. You had roughly the first, I believe it's about 10 weeks of the year. Then we were below a year ago, kind of below even the 5-year average. And as of late, we've seen considerable strength in cutout values. Where does it come from? The belly, the belly, the belly, and to some degree the ham as well. So we've seen the ham and belly year over year. They've only been below 2 weeks throughout the year. They were different weeks throughout the year. And the question I would pose, and it's different for these two primals, is do the belly and the primal follow last year's trend, or do they follow the 5-year average? Now, for the belly, you could argue the strength was if you compare to 5 years ago, or the 5-year average ago. Those were some of the, we were above 180 as we got into late summer prices, whereas year-ago prices were kind of stable in that 120 to 160 range, kind of the average, the 140 range. Now, hams, on the other hand, we've seen all the strength a year ago. And so as we think about seasonally what are impacting those factors, I think it's a bit of a different story as we look across some of those various primals. Similarly, you can look at the cold storage situation. So bellies continue to be notably down below a year ago, 22% below a year ago. We did actually add about 9% bellies from the end of March to the end of April. This is very consistent then with the primal situation. Tighter stocks leading to higher prices, right? Now, that's not the only one below a year ago. Hams also, similarly, we've seen strength in the ham primal. Not surprisingly, we're seeing relatively tight stocks for hams. One thing I'll point out with the cold storage, which I continue to watch for both kind of a supply and demand and kind of movement of products, shock absorber for short-term disruptions, is we've kind of changed this industry a bit. We are at much lower levels than we have historically. So when we're comparing over 5-year averages, we're comparing to a year ago, it's not that surprising that we're seeing much tighter supplies, because those are just the levels that we're comparing to today versus historically in that cold storage sector. Now, demand, we have to look back and we have to look forward. So looking back, we have data, official data, through March. And that data would say, we are running near record exports that we had last year. Muscle cut exports, they were down 0.1%. Value was actually up slightly, so you could call that a bit of a push from a demand standpoint, maybe a little bit lower after adjusting for inflation. Not surprisingly, given the challenges, variety meats are down by volume and down by value, but only down about 5%. Value down about 2.5%. So overall, exports are down a little over 1% by volume. They're up a little bit by value. Now, given all the headlines, we've heard about exports, you may think this is a much better situation than kind of anticipated. This is the challenge of kind of the data availability and looking back versus forward. So as I look forward and look at the weekly data, that doesn't exactly correlate with the official data, much more pessimistic situation, at least from the accumulated exports. So by volume, we're down 14%. Now, we do have 4% more product on the books, so that does provide some optimism. I think that's some goodwill purchases. That's maybe the beginning of some trade deals that we're seeing some higher purchases year over year. But overall, we still are down 10% by commitment. So the question is, do we run much closer to USDA's forecast of down 0.8%? That wouldn't put a lot more product on the U.S. market. Or do we run closer to where we've been here year to date, down about 10% by volume, which would have a more impact on prices domestically if we have to absorb that product. Now, I think it shouldn't be all that surprising to see the changes in some of these trade patterns, though. As we look at China, these are forecasts that have been done for over the last year. There was expectations we've seen less and less product going to China. Back to pre-2018 levels, Also, we've seen some changes. The U.S. has surpassed the European Union for the first time since 2014 as the major exporter worldwide. That division is expected to widen a bit here in 2025. And then to give you some perspective about competition worldwide, you see the size of the Canadian and Brazil exports. So roughly about half the size of the U.S. And so as you look at short term, certainly the size of these industries, the relationships built, will maintain a lot of those trade flows, and really representative of what USDA is at is about a 0.8% decline in exports. Now, currencies matter, and currencies have certainly worked in the favor of the U.S. exporter, our partner importers, in 2025. The dollar index is down about 9% compared to our major customers and major competitors. We've seen their currency get stronger relative to ours, or ours get weaker relative to theirs. And so that's provided them more purchasing power or made us more competitive on the world market. So certainly this has been supportive of exports. A lot of questions about where the strength of the dollar goes from here. And so certainly that could have an impact to some degree on exports. Now, packer margins are the last piece of this demand kind of puzzle as we look at here. These margins are about $6 per head lower as I measure them compared to year-ago levels. We're seeing, however, integrated margins, so packers that own hogs, so using a cost of production versus a hog price, are a bit more profitable now because we're seeing profitability overall in the live animal production side of the industry. Overall, I mentioned earlier, I think we are in a bit healthier spot as we look at these margins. Long-run historical levels are pretty close to break even, and that's kind of where we remain today. The factors that are certainly impacting packer margins outside of the cutout and the hog price are slaughtering and processing costs, which are the highest we've seen. They're up 35% since 2021, and a lot of attention on hog byproduct values. I don't think I've ever talked about byproduct values this much in the last 15 years, right? But they have certainly been impacted this year. You'll note that kind of in that April-May data. And this is a lot of times the driver of profitability or lack thereof from a packing standpoint. You look at those margins, those margins, again, are near break even. With the elimination or reduction of byproduct values, we certainly see much tighter margins and an impact on hog prices. Now, cash receipts are forecasted to be some of the highest that we've seen, at least nominally. So we have to use this caveat now to give you a bit of context. The 2025 cash receipts of a little over $30 billion will buy you less than the $28 billion in 2021, just due to inflation, right? So those dollars don't go as far. We know costs have continued to rise. Now, prices continue to strengthen, much like the cutout values. Kind of we have a tale about three different stories here. In 2025, the hope is we continue on the path that we are, and we see strength in these summer prices that lead to strength as we get into the fall period. Forecast would be for about a 4% increase in 2025. This would come off the 3% increase in 2024. And to give you some perspective, our prices have been on the higher end of historical prices, at least nominally. So before I get into looking at profitability, we really want to drive that point home. That prices have been top 10 historically, even if you go back to 2023. Yet, as we look back at the last couple of years, 2023, by this measure, will go down as the worst year in pork producer profitability to date, at over $30 per head loss. Now, 2024 was roughly break even. 2025, we're seeing about a $15 per head profit. There's a couple ways to look at this. If this proves true, this will be the quickest turnaround in pork producer profitability ever. I pause because the reason is it says much more about how bad the situation was in 2023 and 2024. It didn't get that much better than it says about 2025. So if it's not price, what is it? It's cost. Costs have continued to rise, still 32% higher than they were in 2020. Yes, they've continued to decrease slightly. We did see about a 2% decrease here in 2025. But I want you to take a look at that 2025 cost, or the commodity cost there. 420 corn, 13 soybean meal, distillers grains 143. Joel will talk a little bit more about the forecast and put those into context, but I would encourage you to think about those costs. What was the price of corn back in 2011, 2012, and 2013? Was it 420? Nearly double at times, right? So important for that to keep in mind. As I talked about, we're in the mid-80s costs. I don't see where we squeeze much more decline in these costs then. Because everything else, and I purposely make this graph very busy, it's because all the other costs that go into cost of production have risen higher than inflationary costs, so higher than hog price increases. And the hope is now, and we're not quite there, is that these costs rise just at the rate of inflation, right? And yes, we've seen lower feed costs, but everything else remains relatively sticky. And so the challenge here is, how do we manage these costs versus other costs? There's a little bit of different thinking when you think about it from a risk management standpoint. Now, looking forward, more short-term, 2025, about a $15 per head profit. 2026, through the first roughly 3/4 of the year, it's about a $6 per head profit. On a cumulative profit standpoint, so this gives me kind of an indication of the financial health of the industry. You could choose any starting point, 2020, 2023, the situation's going to look worse. But here shows me that we are just getting back to break even in August of this year, if you start in 2020. So not surprisingly, we haven't seen many changes in inventory levels, because the situation for producers doesn't really get us back to a starting point until later this year. And even that, we've improved those forecasts over the last month. You would ask me the same thing a month ago, we don't get back to break even. You get close, but then we turn negative. So this has changed much different than even a month ago. Producers respond to profits, not prices, right? And here, only modest profits are returning. Now, that forward curve has looked the best it has looked in about the last 2 or 3 years. You have to go back to 21 and 22 for these levels of kind of looking at profitability in aggregate going forward. Now, we've started to reach contract highs. Again, this is the July contract here. Approaching the levels that we've seen earlier in the year. My encouragement always is to kind of think about it from this kind of market cycle here. We've been at this various points on this contract for July, right? We've been at the point of maximum financial risk, which is a little counterintuitive to me, but that's the high, right? Because I have a lot to lose. Now, the maximum financial opportunity, could argue, is early April, where how much lower could prices go? And so as we look at the forward curve opportunities to lock in profits that we haven't seen in several years, we have the tools, the strategies that allow producers to do that, to capture that, but still allow for upside in the marketplace. We'll end with supplies here. So there's been a lot of talk about hog slaughter levels, and I'd really like to see that people have referenced the USDA reports on this, because this is the best data that we have. And they've referenced we've been down about 2.1% slaughter. Who thinks that's true? Thought I'd see more hands. It's right here in the USDA report, right? I believe that. But you have to put this into context a little bit. How many slaughter days did we have this year compared to last year? We've had 2 less this year. Leap year versus common year, and just how the Saturdays fell, weekends fell. When you do that, we're pretty close to a year ago levels in slaughter. You can do a daily average or look at the weekly data, just slightly below a year ago. And I'm going to end with talking about carcass weights that are higher, so production has actually been higher this year. but yet slaughter does show up lower if you look at it just strictly from a calendar date standpoint. Now our hog slaughter, again, if you look at the weekly data, down 0.4%, about 200,000 head lower than a year ago. We beat up USDA a lot when they're wrong in the hog and pigs report, or that they have to go make back revisions. We have to do the opposite when they're right. And they only missed market hog inventories, slaughter levels by 77,000 head this year, total, since March. That's pretty remarkable how accurate that is, right? Long run, they are very accurate in measuring these inventories. At times, we do see the need for revisions, but this one is very accurate. So for me, that tells me we really need to rely on this survey, right? And so I'm going to implore you here the next slide or two, I think we need to really take a look at how do we improve response rates to the hog and pig survey. I wrote about this in National Hog Farmer recently. I reference a research article here from about 10 years ago that looked at the substitutability of the hog and pigs report. And it is the lowest out of any of the USDA reports that the authors looked at here. So what does that mean? There's not information already out there that we can utilize to measure hog and pig inventories. So that even gives me more incentive to say we need to respond to the hog and pig survey because there's nothing else there that analysts like myself and users of the data can use to help understand where those inventories are at. So where we're at is 63%. You would make me feel really good if the survey response rates start to increase. I'd like to do my job of informing users of the data, producers of the data, the value of this data, and so that we can start to see maybe survey response rates closer to the 80% that we seen a couple decades ago than the 63% that we've seen in the latest hog and pig survey. It's the law of large numbers. The more responses we have, the more representative we can believe and think the data is. So on that hog and pig survey, I told you I think it's pretty accurate, the latest one. And so when I look at market hog inventories, my expectation are to be slightly below a year ago from a slaughter standpoint as we get into August. Now we'll get an update here in a couple weeks on that hog and pig survey of where those estimates are at, but I expect them to be aligned with slightly below year ago levels. Now, could I expect them to be a little bit tighter supplies? If you look at one measure, feeder pig prices would suggest that maybe supplies are a bit tighter than USDA is suggesting, just given the sheer price strength that we've seen throughout the year. And you even seen these prices at the time they were purchased, the pigs, they were below or above break-even prices. So prices that needed to break even were much higher. Now I think producers had capacity potentially. They expected a stronger market, or they expected feed costs to possibly decline. We've seen some of that all come to fruition here. The part about maybe tighter supplies than expected is a little bit to be determined as we get into some of these summer months and see what those slaughter supplies are. The latest USDA forecast for pork production for 2025 is an increase of 0.7%. That would be representative of productivity increases, pretty much the weight increases that we've seen. No real change in inventory levels. This last May, they released the latest 2026 forecast, or the first 2026 forecast. They're expecting a 1.3% increase. Don't take that as truth, though. You'll see we make several forecasts every month. Fundamentals can potentially change on those, where those forecasts are at. Now, as we look at weights, overall weights are higher than a year ago, but it's two different ways we get there. We actually see higher producer-owned weights, about 1%. Packer-owned weights are down 0.8%. When you average them out, about 60% producer-owned hogs, you get slightly above a year ago. The other takeaway here in this graph is this is not indicative of, I think, pulling any hogs ahead or backing any hogs up. I think we have a very current market, which is rather healthy and why we've seen some strength in prices as of late. The wild card is litter rates. So we've seen litter rates continue to break records, And when I think about breaking records, it's always at the very minute, tenth of a hundredth or a thousandth of a second, right? It's hard to break records when you get to record levels. Pork producers have shown that it's not that hard necessarily when we look at litter rates. We've seen litter rate growth tremendously, 3-4% at times. Even now, as we back down to about 1%, those are still record litter rates and adding to that productivity increases. My final slide here, I think really hammers home the productivity increases we've seen. We have the second smallest December breeding herd since 2015. Yet, pork producers are going to produce the most pork per breeding animal ever. You get there through increased pounds, increased litter rates, right? So the efficiency, the productivity of this industry is tremendous, and that trend is continuing to increase over time, even through challenges like we've seen in 2020 and 2023. So my time formally, I think, is out, and we'll pass the baton to Joe Kerns.
What we are currently experiencing right now is transitional, right? And we will walk through the S&D and kind of take how that one looks here. And let's start off with this. This is our conditions report. We got the first ones came out 2 weeks ago. Pick your favorite state there. You can probably see some winners and losers. North Dakota, the extremes of the belt, both the eastern and western extremes aren't doing too great. Those of you that either flew or drove into Des Moines today, you look around and go, hey, this doesn't look too bad out here, does it? Right? And we're a pretty big corn production state. And it shows on the ratings. Minnesota improved week over week. Here's what this last week looks like on a state-by-state breakdown. You do see the recovery in Minnesota. We've got some moisture in the forecast. We had rain all day yesterday. We're going to get a little bit more coming here later in the week. Shouldn't disrupt our plans too much for the next couple of days. But we're off to a relatively decent start to where we can achieve trendline yields. And this is going to be important as we roll forward, taking a look at this situation, because right there I kind of put a yellow line of what the start point is right there. And this is like a horse race. You know, we break out of the gates, and as long as we're kind of in the hunt in order to start with, we don't stumble, we're going to be okay. And if you take a look at that dot there on the left side of the screen, we're okay. We're kind of right in the middle. Forecast, at least for the short term, doesn't look too bad. Similar situation, this is soybeans, is those ratings just came out on Monday, and you got to be just a little bit careful here because you've got our crop ratings, what we have in the ground, what is growing versus what we still need to get planted. And we have some concerns again on the fringes. The Ohios that have gotten too much rain, the Dakotas that haven't had enough rain. We are about 4% ahead of schedule as far as planting is concerned. So we've got a little bit of a buffer. So far, what I've shown you, do you have any concern about this crop? Granted, very, very early in the growing season. Any concerns? You shouldn't, right? We're off to a decent start here. When we take a look at the month of June here, you got the temperatures, I think this is going to be the bias, are generally kind of warm. I'm going to talk to you about what the crops look like, but also in your head, I want you to think about what does this look like for livestock rearing. Specifically, what does heat do to summertime gains? How many animals do we have in the barns? And how many new barns are we building? By the way, that's the easy question. That's the easy answer. How many new barns are we building? None. None. You know, construction costs are $350 to $400 per head. Interest rates trading at 7%. A contract rate from a grower, he can't afford to pay you anymore. So we're at this absolute standstill, right? And so I think we've got a structural problem that still needs to be addressed at some point in time. A few of us were at the PIC conference here recently, and it just coincidentally happened that they got approval for their PRRS-resistant pig that came out at about that same time. And maybe that's the buffer. But how many sows do you think we need in the United States if suddenly we're going to start to save just a few more, right? This is going to get interesting, guys. This is going to get very, very interesting. And when Dr. Lee talks to you about the health of our industry, largely it's been built on depreciation. Accelerated depreciation has got us to this point, and it's really gotten us to this point if you've got some new green paint in the barn, right? Right? We're in for it. I think it's going to be a fascinating transition. Back to our story here. This is what June looks like from a weather standpoint. From a precip standpoint, Not all bad. You're going to see this as a consistent theme, by the way, is that the eastern side of the United States looks like it's going to stay moist. The northern, western, kind of the Dakotas, are going to stay reasonably warm and dry, and that's a pattern that's entrenched. It's a pattern we've been in for the last 2 years. We're still kind of in this, and it does look like it's going to sustain us here. This is the one that probably jumps out at me the most. This is our summertime. Does anybody notice a bias there, by the way? Right? We're going to be warm. We are going to be warm this summer. It's almost inevitably. The only question is how much warmer than normal are we? And again, this is part of this lingering La Nina that we've got going on. And this is a consistent theme, is that the eastern portions of the belt are favored with moisture. The western portions are a little bit suspect here as far as moisture is concerned. So far, do you see anything to really, really rock your boat? Nothing. We don't have anything too bad here, right? S&D just came out. We got our first S&D in the May report. Lee was talking about the middle of June. We'll get another one. Here's what the numbers look like. Allow your eyes just kind of roll down to the bottom of that chart with the 2025, 2026, if I've got a pointer right here, right here, is $4.20 a bushel. As a pork producer, can you live with $4.20 corn going into your rations? Absolutely. What did we have last year? $4.35. Could you live with that? Let's take a future string, 2026, 2027, 2028, all active contracts on the Chicago Board of Trade right now. What do they average? About $4.40 in the cash market. What do you guys think about that? It's all right, right? I don't think we've got anything to worry about. This is not an ominous forecast from the input standpoint for the pork production community as we roll forward here. This is what December corn has looked like. We have been lower, but not too doggone much, right? We're at our lows. I do think that we're going to move lower, and I'll show you that here in just a moment. If you regress back of the price versus a cost relationship on a supply and demand on carry out to use ratio, it would we're slightly below where we should be, quote, should be on that line. And I do believe that's the lack of confidence because of the political influence that's kind of suppressing those prices here just a little bit. Soybean situation, similar here. I've given you soybeans, but we'll translate this into soybean meal. Let's just call that around $10 a bushel, which puts your soybean meal around probably $275 to $300 a ton. How many pork producers in this room would take $275 soybean meal for the next 4 years and say, I'll take it? We got one smart guy right there, right? $4.25 corn, $4.50 someplace in the neighborhood, cost of production. Soybeans, the same story, cost of production, right? Now, let's spin this back a little bit because we got a little bit of a bias in general, right? We consume more than we produce. If you are a grain producer, and just take a look at this, what do you say? Honey, I should have been a doctor, right? This whole farming thing was a great idea at the time, but this isn't looking so good. Let's take a look at economics. The state of Iowa grows 30 million acres of corn, about 30 million hogs actually roughly produced. So let's just say we make $10 a head. A really good year on hogs. $30 million times 10 million is what? Mathematicians in the group, help me out. $300 million worth of profits coming to the state. We've got 30 million acres. If we make $100 an acre, what's that? $3 billion, right? Which one's more important to the state coffers? The grain side or the livestock side, right? Grain side dwarfs it as a 10-to-1 ratio, right? Kind of given my parameters there of something that would represent profitability that you would expect, right? We, in the state of Iowa, I think have an income problem that's just going to be smashing us down overhead at a time. This is the governor's trying to lower some taxes. I applaud that. We've got some tax reform situations that we're debating. But right now, the revenue for an agricultural dependent state, the revenue prospects aren't looking all that grand for the next 4 or 5 years. That works well for us on the consumption side, but that's about it. Soybeans kind of hovering around that $10 level. I just don't see them going too far. Again, the confidence level that we've got for the U.S. being a reliable supplier to the world has waned. There's some economic reasons too with Brazil that I'll talk about. As long as I was throwing up charts, I decided to throw this one. This is where we should be, right, guys? Right? All right, let's just grab a coattail of what's going on in the beef market. Made new record highs on Monday. Had a little bit of a wobble here recently, but that's a heck of a chart. World situation. You'll see that that we've got a world scenario that's up about 43 million metric tons. United States is about half of that. Argentina, Brazil, kind of hampered a little bit of what their potential could be because of the El Nino. But we're not running out of corn in the United States. We're not running out of corn in the world. When you take a look at the Brazilian corn S&Ds right now, you can just kind of see what corn production is looking like. And just kind of pay attention to May of this year versus where we were last year on all those numbers. And you'll discover that our number one export competitor is not getting any smaller. Matter of fact, what they call the safrinha crop is just coming off right now. Is planted back in February. Starts to get harvested. That's about 75%, or it's actually, I think, 76%, but 75% plus or minus of the Brazilian production. Almost all of that goes into the export channel, and that's why we roll over exports in the United States at about this same time. There's a map right there. By the way, I spent New Year's Eve right there, and I'd highly recommend it if anybody gets an opportunity. We were just south of Sao Paulo with the kids. That was a party that was going on until 3 o'clock in the morning every night. One of us went to bed early. That was me. Right. When you take a look at precipitation, that red line is 2025. I was sharing with you that the La Nina tends to have drier than normal production outcomes. But if I just told you that production's going up, yet yields are suboptimal because of moisture, what's that tell you? There's one piece that's missing there, isn't there? Acreage. Acreage is up 5% year after year after year. If and when we ever shift from La Nina back to an El Nino and start to populate the southern portions of South America with some more moisture, guys, look out, because we're going to blow the doors off of this one. And some of those numbers that I was sharing with you might even get a little bit more aggressive. World situation, we're pretty static. We got about 6 million metric tons more, almost all of that coming out of Brazil. And again, that's added acres. That's not fantastic yields. They just keep on adding acres. We did have we've had a discrepancy that's been rectified. CONAB, which is the Brazilian equivalent of the USDA, gives an estimate. The USDA gives an estimate. And you can tell 22, 23, 24, they've been way disparate, right? By the way, the USDA has been right on all three of these. We've kind of closed that gap here now, where we don't have that great big discrepancy. So I think we've got a little bit more confidence in what they look like. Kind of rounding out South America, Argentina's right in the middle of their corn harvest right now. Nothing too notable there. Soybeans are largely starting to finish up right about now, just close enough to being normal. I shared with you that the Brazilians start to take over the export market right about this time. So I expect our exports out of the United States have hit their peak. They're going to start to roll over, and perhaps roll over a little bit faster even than what we'd anticipated. This is the chart that if you want to be bearish, that I think you've got some good evidence. That black line is what the funds have been doing. And notice they've been selling a position. And if I was to overlay what's the price of corn with what the fund position was, it would largely mirror one another. Fund selling comes back into the market, pressures it. Take a look what they did in 2024 from here on out, right? Ooh. What if the funds take a look, a crop growing in the field that doesn't look too bad, a world situation that's saturated, a U.S. balance sheet that's not in any concerns whatsoever, and they want to make a little bit of money. What do you think they're going to do? They're going to sell it again, right? Maybe beyond what logic would say we need to be at, and we're starting to see a little bit of that with what's going on with basis right now, but I still think we could get the funds into the middle of the summer to repeat their pattern of 2024, and that would not be supportive of corn prices, all right? Let's hit some conclusions right now. There is nothing to panic about as a pork producer. So Lee was talking about added revenue that we've seen in getting a little bit of recovery, especially the healing that we've needed since 2023. The cost of production, I think, is not going to be anything that's going to rock your boat here. We're not going to have another ethanol binge. As a matter of fact, anybody that's adding infrastructure based on governmental policy, like we did with the ethanol boom, right? How's that one feel right about now? Terrible, right? We've added all this soy processing capacity, and that's kind of helping us on the soybean meal side in the promise that we were going to have more soybean oil that was going to go into renewable diesel. What about a pipeline? What about a carbon pipeline in order to save the ethanol industry? What do we got going on more locally? Right? And so if we as agriculture with a capital A are looking for some type of growth, I don't see it on the horizon right now. There's some hope for the animal agriculture side, the crop side of it. I just don't think is going to get off dead center here, right? Funds are on pace to repeat themselves, which is what we were talking about. Does anybody remember Sell, Mortimer, Sell? By the way, that's where's that line from? 1985 movie, Eddie Murphy. There we go, Trading Places. Epic movie there, right? And because of the volatility in Washington, it's tough. It's tough for any customer of U.S. grains or maybe anything else. And I think hogs have largely been exempted from this. If tariffs are going higher, but then it's no, never mind, right? Right? Do we have steel tariffs? Do we not? Right now, it's kind of an interesting one. We've got steel tariffs with everybody except the UK, so now we're getting all these carve-outs that go on. But all of this volatility leads to a lack of confidence. That lack of confidence in the United States it becomes less trusted trade partner, decreases exports, pushes more corn back to the bottom line, and is that to our benefit as pork producers? Get real selfish for a second. Is that to our benefit as pork producers? Yes. Yes. And so you take all of this confusion. I think the bottom line is you take all of this confusion and the consternation and the hand-wringing about what does policy look like, and if you get really, really selfish for a moment, you get quiet and go, hey, that's going to work out okay for me. And I do think that that's where we sit right now, all right? I think that's where I've got, and with that, I've got us back on schedule here.
With that, folks, please do me a big favor and put your hands together for Lee and Joe. They did a wonderful job. Thank you, gentlemen.
Thank you.
Good job, Joe.